If you are self-employed and you are applying for a loan, one of the biggest things you need to understand is this. Your revenue is not always the income a lender uses to qualify you. This is where a lot of self-employed borrowers get frustrated. They'll say, "My business brings in good money. I have deposits coming in. I have money in the bank. So why is the lender saying I don't make enough?" A lot of times, the answer comes back to the tax returns. For self-employed borrowers, lenders will often ask for 2 years of tax returns because they are trying to verify income that is stable, documented, and consistent. But here's the double-edged sword. As a business owner, you may have legitimate business expenses that reduce your taxable income. From a tax standpoint, that can be a good thing because it may lower how much you owe. But from a lending standpoint, it can work against you. The more expenses you claim, the lower your reported net income may be. And when a lender is using tax returns to verify income, they are usually looking at income after expenses, not just gross revenue. So if your business brought in $300,000 in revenue, but after expenses your tax return shows $40,000 in net income, the lender may be qualifying you closer to that lower number, not the full $300,000. And that can be confusing because the borrower is thinking, "But I have a real business. The money is coming in." But revenue is money coming in. Net income is what is left after expenses. In other words, lenders are usually focused on the bottom line number, net income, not just the top line number, gross revenue. This is why self-employed borrowers have to think ahead. If you are planning to apply for a loan soon, talk to your CPA or tax professional before filing your taxes. Do not just think about reducing taxes. Think about how your income will look on paper if a lender reviews your tax returns, because the same deductions that help lower your tax bill may also lower the income a lender can use to qualify you. Cash in the bank, good revenue, and strong bank statements can all help, but they do not always replace income verification. So the takeaway is this. If you are self-employed, your tax strategy and your lending strategy need to work together. Saving money on taxes is great, but if your reported income is too low, it can make it harder to qualify when you need financing. And before you go, quick reminder, everything on this channel is for educational purposes only. This is general information based on my experience in small business lending, not financial, legal, tax, or lending advice. I'm not speaking on behalf of any specific lender or employer. Every business and lending situation is different, so always work with a qualified professional for your specific situation.